The Dow setting up for a lower close to the tune of more than 1,000 points. And there you do have the closing bell on Wall Street, which means for us, it's market domination overtime. Jared Blickery is going to be along in a moment to give us more details on the action from today. But as for the major averages, indeed, the Dow ending lower by 1,015 here today, off by 2.5%. If you look at the past 5 days and the action we have seen here, it's interesting that the gains that we saw yesterday, we now have come down from those levels. So that's something to note. Or to look at it another way, you can look at the year-to-date chart as well, where you saw the big gain yesterday, but we've still come down from those levels. And of course, we're still lower on the year. As for the S&P 500 today, we saw a decline there of 3.5%. And as for the NASDAQ, down by 4.3%. The euphoria of yesterday replaced by a little bit of reconnoitering here as a couple of things happen. A, even if the base case is 10% tariffs everywhere and 125% tariffs on China, not great. And of course, the White House clarified today that the tariffs on China are actually 145%. We've got this 90-day negotiating period. Negotiations seem to be happening, but we still have that big word hanging over us, Jared Blickery. That word is uncertainty. We don't know where all this is going to turn out.
Lots of uncertainty, and just to linger on some of these charts, here's the Dow, quadruple digits. I'm old enough to remember when triple digits was a thing, but this is roughly 2,000 points here, and then look at the 5-day, that's about 4,000 points. This is just an incredibly volatile market to be in, and that's just because there's no liquidity. That means funds and other big institutional investors are not willing to step in and provide that liquidity that the market needs to function. And when does it come back? Well, that comes back with some certainty, or at least a little bit less uncertainty. VIX here, I got the VIX up. It is down to 47. Well, actually, it's up from yesterday, but it's down from a high of 60. 47 still very elevated. Took a look at the ICE-BofA Move Index. Here's a year-to-date or a one-year chart on that, coming down from the highest levels in over a year. So we're seeing the bond market do its thing. And then the US dollar index. This is the third biggest drop. Today is the third biggest drop in the US dollar index since the global financial crisis. So there is still some big moves going on. When you see big moves in currency land, more than 1% here, and we're talking 1.7%, that is a very leveraged field. And that has sometimes even more disruptions than movements that we see in the bond market. I'll go to gold real quick. That's up to very close to another record high. That was up 3.6% today. And I will move on to some of the sector action so we can get a visual representation. The green stands out. That is consumer staples. Next up it is utilities. That's just slightly in the red. But what really matters here is energy down over about 6.5%, tech down over 4.5%, and consumer discretionary down over 3.5%. Those are all the underperformers. And then you can throw communication services and materials. I'm going to leave you with a picture of the NASDAQ 100, worth 1,000 words. Send it back to you, Josh.
Thank you, Jared. Let's bring back in now Lori Hyman, Global Chief Investment Officer at State Street Global Advisors. Lori, it was interesting to hear from a couple different guests we had today, Lori. I was struck by how two smart guests independently told us the same thing, Lori. They said, it looked to them like the Fed was actually going to achieve this soft landing. As rare, as unusual as that is, they said it really did look like Jay Powell was going to pull this off. So, low inflation, low unemployment, solid growth. Now they said, not so sure. But it struck me how two folks said that independently, and I'm just curious to get your take on that.
No, absolutely. Coming into 2025, we were of the same mind, and not just the Fed, but central bankers globally seem to have navigated that soft landing in a way that set us up for reasonable growth in 2025 and actually building momentum in many parts of the world. And now we're in a different situation. We were actually talking earlier this year about Chairman Powell cutting because it was the right thing to do. And now we're talking about Chairman Powell needed to cut because you have to. So it's a very different dynamic that we're experiencing here just a couple short months into the year.
So Lori, what's the best case scenario now? Is there a best case scenario now? Even if a magic wand was waved and somehow President Trump said, oh, no more tariffs, forget it. Is the damage done both to the markets, to the economy? I mean, how could things turn out here?
I mean, first of all, we just need to get to something that's more durable. I mean, this idea that we have changes in policymaking on a day-by-day basis, it just makes everybody uncomfortable, right? It makes it difficult for businesses to say what they're going to do to react to that. It makes it difficult for consumers. We've actually seen inventory building. We've seen actually certain sectors benefit from advanced sales because people are worried about inflation. So I think getting to some kind of certainty would be very helpful because then people can start to work through the math. Okay, what does this really mean in terms of corporate earnings? And I think a notable thing, we actually were looking at some of this earlier this week, and the market reaction at that point in time had far outpaced what we thought the underlying fundamental corporate earnings impact was going to be. So that starts to give you some confidence, but you need that certainty of what the landscape looks like to be able to build that case.
Lori, you mentioned corporate earnings, and of course, earnings season is here. Big banks tomorrow, Lori. I'm curious, what do you expect? What do you expect to see and hear this earnings season?
Well, overall, Q1 should look okay. So what'll be more interesting is what they say about the forecast. What does the outlook look like? Because for the most part, Q1 was in the bag before we started to have all this tariff drama sort of take effect. So it's going to be more about what are they signaling in terms of what they see going forward versus what they actually achieve for Q1.
We talked earlier a little bit about strategically where you guys are going. I'm curious about gold as well, because I know you wrote that you all have been increasing your gold allocation to some extent. Talk to me about the thinking behind that and whether that's continuing.
Yeah, we have. And in fact, if anything, we've been upping our allocation to gold. Now, it's still a relatively small allocation in the broader portfolio context, but for many months now, we've been talking about the idea that gold just has some very interesting properties. It's one of the few diversification assets against a backdrop where bonds and stocks have been more correlated more often over the past couple of years. It's one of those assets that protects you against extreme outcomes. It protects you to some degree against currency debasement. So there are lots of things to like about gold. So we think that that's one of those assets that you want to be really focused on in this kind of environment.
Lori, thanks so much. Great to see you.
Yeah, thank you.
Well, speaking of gold, it touched a new record on Thursday. Let's get to Yahoo Finance's Ines Ferre with more on the latest moves. Hi, Ines.
Hi, Julie. Yeah, and gold touching and knocking on the door of 3,200 because we saw gold futures going up to 31.91. In fact, 31.94. So just $6 away from that 3,200 level. This is for the futures, and spot gold also touching highs. Look, year to date, gold is up about 20%. I've seen a lot of notes and spoken to analysts about gold and that uncertainty that you guys have been talking about, and that has been cropping up more and more in a lot of the analysis. In fact, I saw some analysis talking about investors flocking to gold as they lose confidence in U.S. policy. So a lot of that uncertainty has pushed the price of gold higher over the last few days, and a weaker dollar has also contributed to that. The risk of stagflation, the risk of an economic downturn, and also at the same time inflation, that has also sent gold futures higher. And of course, central banks have been buying, and we've been seeing an increase of inflows going into exchange traded funds, ETFs.
And while we have you, Inez, what is the latest on gas and oil as well? Fill us in.
Yeah, so we saw that gasoline contributed to that cooler than expected inflation print for the month of March. And if we take a look at a year-over-year basis, we have seen that gasoline prices have come down year over year. And if we take a look at what the prices are right now, we are seeing that over the last week, gasoline prices have been ticking lower. They're at around $3.22 per gallon. And I've spoken to a couple analysts asking them, hey, now that oil has come down about 15% since that April 2nd reveal on the tariff plan and all the volatility that we've seen in the market since then, they're saying to me that you can expect oil, because of those lower oil prices, for gasoline prices to also go down in the coming weeks. Andy Lippo of Lippo Oil Associates is saying that by about 15 cents per gallon in the next couple of weeks. And if oil hangs at around these levels, he says you can expect them to go even lower than that. And Patrick DeCahan of Gas Buddy is saying that you could see gasoline prices coming down below that $3 threshold. because of the impact of these oil prices, because of the tariff uncertainty, and also, of course, because OPEC Plus is going to be adding more supply into the market in May.
Thank you, Inez. Appreciate it.
Thank you.
Stick around. Much more market domination overtime. That's still to come. Market selling off today as President Trump's trade war continues today, increasing the tariff on China to 145%. For more, we're bringing in Yahoo Finance senior economist Rick Newman. Rick.
Hey, guys. I heard one analyst today describe that 145% tariff as an effective blockade of U.S. imports and suggesting that Chinese ships wouldn't even leave ports bound for the United States as long as that is in effect. So this started out as a Trump trade war against the world, and I think we're finally sort of like getting to the point of what Trump actually wants to do. He seems to realize that he can't sort of take on everybody, so he's really going to focus this on China. And I think importantly, Trump has also shown some of his pain thresholds. I mean, we got a bear market in the U.S. stock market. Stocks down almost 20%. Perhaps more important than that, we saw this wobble or quiver in credit markets where long-term interest rates should have been going down, but they were going up, probably because foreign investors were selling the dollar and people were piling into treasuries. So that probably was the thing that really got Trump to call off the reciprocal tariffs on April 9. So China knows that. China sees what Trump's vulnerabilities are. And at the same time, China is basically saying, we accept the fight. We're going to go the distance here. So there is no way to know how this ends.
There is no way to know how it ends. I mean, and we've heard a lot of opinions in either direction as to how strong China's position is in terms of its leverage, Rick.
Right. So this will hurt China. China would prefer to avoid a trade war. But, you have to think a little bit about how Xi Jinping, the president, has positioned the country. He has been telling people in China for years that China needs to develop more self-reliance. They cannot remain dependent forever on selling cheap stuff to the rest of the world. Clearly, Xi aspires for China to be a superpower. And without a doubt, he resents and really bristles at trade bullying from Donald Trump. So, we went through some of this similar rhetoric back in 2018 and 19 between the two countries, but the stakes were far lower. So Trump has really declared a trade war on China, and China's a proud country. So if China is going to find a way to make some kind of deal with Trump, it's going to have to be, the old-fashioned way where there's some face saving on both sides, and nobody has to say they beat the other. And both sides are just digging in their heels right now. So we're going to see probably some large price increases within, 5 or 6 weeks on a lot of these products that come from China that we cannot readily get from someplace else.
Rick, thanks a lot. We'll keep watching it. Appreciate it.
Hi, guys.
Well, U.S. stocks, of course, taking a beating as investors assess the impacts of the tariff escalations with China. But let's talk about pockets of investing opportunities on the Chinese side. We got Crane Shares Chief Investment Officer Brendan Ahern joining us now. Brendan, as we watch KWEB, your ETF, very closely, it's actually up a little bit still on the year. We've seen some standouts, the likes of Alibaba, for example. But what happens now that these huge 145% tariffs have been imposed?
Yeah, I think there's a little bit of unfortunately, we're stuck in this tit for tat retaliation. I think ultimately the Chinese government is taking the view that less than 3% of their GDP is represented by U.S. Trade with the United States versus 70 to 80% of the U.S. economy is dependent on consumption. So I think China's going to be much more focused on raising domestic consumption. There's a lot of talk about coming domestic consumption stimulus. That might actually come overnight. There's some rumors there. So I think China is basically saying, we're just going to focus on what we can control. And if the U.S. wants to cut off access to our products, that affects the U.S., then maybe it affects China.
Brendan, correct me if I'm wrong, because I often am, Brendan, but I feel like last time we spoke, were you in the camp that believe, listen, at the end of the day, there is going to be a grand bargain made here between Trump and Xi? Am I right about that, Brendan? Was that your position? If it is that still your position? And what do you think the outlines of such a bargain could actually look like?
Yeah, I mean, definitely we thought, President Trump is a successful business person, that this was the art of the deal, that he's expressed that he has a personal relationship with President Xi. Close advisors like Elon Musk are heavily exposed to China's economy and know China well. So we thought, there's a real recipe for a mutually beneficial deal to take place. I think other advisors in the Trump administration recommend taking a very hard stance out of the gate with these exceedingly high tariff levels, which, really, again, I think it's probably surprised the China side. But now that they know what hand has been played by the administration, I think they'll make a pivot toward domestic consumption, knowing that these tariffs really hurt the U.S. consumer potentially far more than it hurts the Chinese economy. And maybe this tactic from really, I think, promoted by certain advisors within the administration backfires on the U.S. Obviously, you've seen the reaction in the U.S. equity market. It's a very costly economics 101 lesson, with trillions of dollars of U.S. wealth lost in instigating a trade war when they could have gone about it in such a different fashion.
And so are there Chinese companies that you think are sort of better positioned while all this is going on?
Well, I mean, it's self-serving and highly biased, but, I love the companies we hold within KWeb because they're geared to the U.S. Chinese domestic consumption story. They basically have no revenue to the United States. I would caution that, there's rumors that does the administration try to put pressure on China by talking about ADR delisting? For that reason, we've really converted the vast majority of our KWeb holdings to the Hong Kong share class, where, it's something that we did a while ago. But I think investors, it's something that we're hearing talk about, do they go after? But again, we've seen trillions of dollars of U.S. wealth hurt by this tariff policy. The U.S. ADRs are held by U.S. investors. If you delist them, you do not hurt China. You hurt U.S. investors. It's really hard to explain some of the things that we're seeing out there.
What are the actual probabilities you give that, Brennan, delisting?
I mean, hopefully it's low. The idea of delisting was because Chinese law prevented the Public Company Accounting Oversight Board from doing audit reviews. The Chinese changed their law. The PBOC and SEC have publicly stated the companies are complying. So I think this is where, if I was an Elon Musk, I'd be very worried, because this feels like a direct attack, really trying to, I don't know what the thought process is of the ADR delisting. Again, you're only going to hurt U.S. investors. Let's be very clear. So it seems a nonsensical approach. But again, it's why we've moved out of the U.S. lines where we can.
Here's what, Brendan, just to get your response, here's what Kyle Bass said about on X. Here's what he posted. I would love to get your response. He said, we should have delisted Chinese stocks when the Communist Party of China refused to allow Western audits. Can you imagine how much fraud is hiding under those Chinese reported numbers? What do you say to that?
Please visit sec.gov/HFCAA, because you will read the SEC on their actual website say that the companies adhere to U.S. regulatory standards after the PBOC went to China and met with their auditors, who, by the way, are companies called PwC, Ernst & Young, Deloitte & Touche, KPMG. I mean, talk about someone you should not listen, that clearly has no idea what they're talking about.
Let me ask you this, Brendan. There was an interesting piece in Barron's today. I want to get your take on this. And it was sort of gaming out what Xi's next moves could be. And they were listing things like he might finding ways to support his exporters, allowing his currency to weaken, maybe going after big American companies. What do you think? How would you rank probabilities there? What do you think his next moves are?
I mean, are they going to devalue their currency by 150%? I mean, that hurts Chinese households. So this devaluation concern, I think, is I think China's going to say, we know what the U.S. policy is. We're going to focus on domestic consumption, which we can control. And I think we're on the precipice of significant Chinese stimulus because the perception is that 1.4 billion Chinese people are making iPhones only sold in the United States. That's just not true. You need to kind of do the math and just look at ChatGPT. Ask ChatGPT, how much of China's GDP is dependent upon U.S. trade. It's less than 3%, less than 3%. So if you can raise domestic consumption, you can more than offset that weakness. And again, I think this really, really hurts the U.S. consumer. I think you're really going to see already a contraction in U.S. consumer confidence. It's really going to play on the consumer here, which represents a disproportionate percentage of the GDP. It's kind of scary if you start to really think about it. I really hope cooler heads prevail.
I could ask ChatGPT, but I would always rather prefer to have you, Brendan, on the show. Thank you so much for joining us.
Feelings mutual.
Appreciate it. Thank you, sir. Stick around. Much more market domination overtime still to come. Well, stocks resume the Trump tariff sell-off with the Dow sliding 1,000 points, and Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Josh.
All right, Josh, yesterday the story was tariff delay, stocks rip, right? S&P had its best day since 2008.
Everything goes higher.
Turns out the tariffs on China were a little bit higher than we initially thought, right? So yesterday Trump had posted that those tariffs would be 125%. I think broadly a lot of people weren't accounting for the math there, that adds on to 20% tariffs that already existed. And here's what that does to your tariff charts. And we're now up here. This is estimates from Yale's budget lab showing that the effective tariff rate right now in the US is about 27%. Notice, first of all, highest tariff rate in a century, right? Second of all, this previous estimate that I highlighted here, Josh, was the estimate after what Trump called Liberation Day on April 2nd. So over the past week, the tariff rate, despite these delays, has actually gone up. And I think you saw the market sort of just react to that today, right? Okay, yesterday we thought maybe we're done with the tariff tape bombs, at least for a little bit. And not so much, Josh. So that tariff news came out around 11, and that's when you hit your market lows for the day. So you saw the market try and come back a little bit throughout the afternoon session, but generally speaking, it just doesn't seem like a very liquid market right now that people want to be in.
So then to your point, so you're faced with all these same questions about tariffs and what it means for economic growth and what it means for corporate earnings. At the same time, what do you do with the market here, which has already been plenty banged up? And as an investor, like, you want to get bearish when a post could come at any minute.
Yeah, so
it just rips you again to the upside.
Right. So let's go to the heat map, Josh, and show you why maybe getting bearish, like you said, isn't necessarily the move here, right? So when you saw these big moves in stocks yesterday, right? Let's look at Nvidia, which is actually a pretty popular short at times. Part of this is definitely a short squeeze going on here, right? So people that got short some of these Mag 7 names, as you said, they call it a face ripper on Wall Street, right? That's what happened yesterday to a lot of the people in those names. So I don't see a lot of strategists recommending getting short this market right now, but I think the bigger question is, do I get long? And I don't think there's a lot of strategists pounding the table.
When you talk to strategists and read the research, you still don't hear people saying, all right, time to step in, back up the truck.
No, more people are saying probably some more chop ahead overall. And I think that's because right now, all we have driving this market is what Trump is saying on tariffs. Maybe that will change come earnings season, but I want to flip over to a second chart for you to give you a little bit on the economic data and sort of what I'm talking about. Josh, this report came out this morning. This is CPI, this is inflation, this is core inflation at its lowest level in 4 years. And the stock market just fell 3%, right? This is a report that normally the market rallies on. When you see good inflation, you want those prices to come down, right? This is a good trend you're seeing here overall. Market didn't react to it, and I think that gives you a sense of sort of where we're at right now with the data.
In your opinion, because you got CPI, you got jobless claims. If you were normally looking at those reports, I think your takeaway would probably be things look broadly solid. But of course, investors are like, okay, that was yesterday's news, and I'm just worried about what's coming.
Yeah, I went back and looked at the market action in the past several CPI days, and I mean, when you get a weaker than expected print, Wall Street had been expecting 3%. We got 2.8. Normally, you see stocks rally in that moment. So I think right now, uncertainty still remains sort of the word of the day, and really the word of the market until we get a little bit more clarity, perhaps again, maybe from some of those companies. Got earnings season tomorrow kicking off.
Earnings season tomorrow morning, the banks. Thank you, Joshua. Swiss drug maker Novartis saying on Thursday it plans to spend $23 billion to build and expand 10 facilities in the U.S. as it grapples with renewed threats of drug import duties from the Trump administration. According to the company, this commitment enables Novartis to expand on its current manufacturing, research, and technology presence across the 10 country with 10 facilities, including 7 brand new facilities, creating nearly 1,000 new jobs at Novartis and approximately 4,000 additional U.S. jobs. Julie, over to you.
Yeah, so all of this means Novartis is going to be able to produce 100% of its key medicines in the U.S. That is a significant increase from current levels. Why is it doing it? Tariffs, in a word. This is the third largest of recent commitments from the drug makers. Johnson & Johnson made a $55 billion commitment. Eli Lilly, a $27 billion commitment. Novartis coming in at number 3. This is the first EU-based company. It's Swiss, as we said, that is making this kind of commitment. And the administration has not yet announced sector-specific tariffs for pharmaceuticals, but President Trump has repeatedly said that they are coming, even as some of the other tariff back and forth has sort of superseded or subsumed the expectations for what's going on with future sectoral tariffs. They could still be coming, and the drug makers are trying to get ahead of them. So Novartis, the latest to do that. We'll see if there are more to come. Stick around. We've got much more Market Domination Overtime still coming your way. Retail investors who were buying the dip saw a massive payoff, at least momentarily. Retail portfolios gaining 17% on Wednesday amid the historic rally in markets, according to JP Morgan. But with stocks falling back down to earth as tariff concerns fester, we're looking at what's ahead for the retail trade and retail traders with Yannick Malling, co-founder and co-CEO investing platform Public. Yannick, it's good to see you. Thanks for coming in.
Yeah, good to see you guys.
So, what's going on? What's new? No, what do you know?
What
have you been?
Quiet week at the office. Nothing crazy.
Have you been seeing a lot of retail investors continue to buy the dip, continue to step in amidst this volatility?
Yeah, absolutely. I think you saw at a macro level retail inflows hitting record highs last Thursday. I think maybe on the Friday as well, on Tuesday. Unsurprisingly, our platform has as well, and I think we focus on generally like longer-term investors building portfolio for the long haul. So we've got stocks on the platform, but also bonds, which has been interesting to see how that played out. We launched that last year, which added obviously another dimension to this. And we're serving mostly people, millennials, right? People in their 20s, 30s, and 40s. I think somebody told me that for millennials, this is the fourth once-in-a-lifetime market drop opportunity to buy the dip. And so that also means that it's not the first time this has happened. I think actually folks have been through a few cycles now, and I think they have a little bit more confidence, at least, in putting money to work. And I think that's a big part of why you're seeing those record inflows across the board.
And the retail investors who are coming to your platform, when they're buying, what line of sight do you have there in terms of what they're buying? What interests them, what excites them, what sectors, what stocks?
The Mag 7 is very popular, right? The most traded stock every single day, most bought stock has been NVIDIA, unsurprisingly, especially on a day like yesterday, from the morning though, thank God. And and so like unsurprisingly, and then there are some retail names that are really loved. There are things like Palantir, obviously Tesla as a heavily traded stock. So there's a lot of Mag 7 activity, but there's also some people obviously in Bitcoin, and like I say, also some folks getting more into the bond market as well. And I think that's maybe been one of the more interesting kind of things where if you look at all those other once-in-a-lifetime opportunities or big kind of moments in retail, it's been mostly focused about stocks or crypto, and this time sort of the bond market is really part of that movement as well.
Do you see people getting washed out, though, as well? In other words, I don't know if you allow leverage on your platform, forgive me, but, are you seeing anybody get into distress?
We do have leverage on the platform, but not really, to be honest. We also have like a 4.1, 0.2% APY like high yield account. And so really the behavior that people much more have is they started to load into that, looking for the dip so that funds are readily available. They also know funds are sitting there, not just doing nothing, they're still earning like a 4% yield while it's there. And then deploy from that directly into equities, typically when they drop. And so, obviously a little bit of elevated margin trading, but really not that much. I think people are getting smarter, and I think that they know that to lever up in times like these is a really risky move.
Yeah, I'm curious because there are other apps and platforms that offer broadly similar services to you all, probably target broadly a similar demo. Like, what makes you guys different?
Well, so we're actually the only one that has bonds. So in this cycle, that's been a really interesting thing to watch play out. We've also fractionalized bonds, so you can sort of buy smaller increments. I mean, in the corporate bond market, sometimes the minimums have been as high as like $50,000, $100,000, right? So we brought all the way down to a $100 ticket. And then I think generally, having all those assets all on one platform makes us a little bit more competitive in terms of being sort of the primary or the sole platform provider in terms of all your investing needs, because I think you've been through a proliferation of app-based investing, but it typically has been like my crypto here and my stocks here, and if I do bonds, there hasn't even been a mobile app for that because the last time yields were this high was pre-iPhone, quite frankly. And so we've really been the first to bring all that all together in one platform, and that gives us some competitive edge in terms of having people consolidate stuff with us.
Yeah, and people could do it through TNX or through an ETF, for example, but not necessarily directly. Would you then say that this is the market cycle where retail has really discovered bonds in a new way, or that has now, it's not a new product, obviously.
Right. No, I would say so. I think historically we're going to look back and kind of realize that. We launched, and it's not just right now, right? We launched T-bills, treasury bonds all the way back in 2023. I think the 6 months T-bill in 2023 was actually the most invested in asset on the platform. If you remember, the yields obviously were like 5% plus. We've launched something called the corporate bond account, which targets a 7 to 8% yield and automatically invests in a set of corporate bonds. So I think you've seen sort of the stepping stone leading up to this moment, and I think this is just more fuel to that fire.
Yana, great to see you and great to have you on set. Thanks for coming in.
Yeah, thanks for having me. Thanks.
Coming up, Trump's tariff spree adding a new layer of pressure for retailers. Stick around. Much more market domination overtime. That's still to come. Trump's tariff spree adding a new layer of pressure for retailers. Now Yahoo Finance's Brooke DePalma joins us now with more. Brooke.
Yeah, good afternoon to you both. As if tariffs weren't enough, anti-American sentiment against U.S. brands is something that has Wall Street concerned as well, particularly looking within retail. Some that have the highest sales exposure in China include Nike, Skechers, Tapestry, and Ralph Lauren. Now, analysts have told me that this could see a small percentage in other regions like Europe and Canada, but they are most concerned about their exposure to China, particularly because U.S. brands have already been struggling in China amid aggressive local competition. You also have a slowing economy there where consumers are also hyper-focused on value and innovation that's really driving consumer behavior there. If you take a closer look at what Nike saw in the region last quarter, we did see a 17% drop in their net sales. They came in at $1.73 billion. That was compared to $2.08 in the year prior. The CEO said that they see the long-term opportunity there. Of course, this was prior to this coming week. They also said they made significant investments in China. And taking a closer look at Skechers, they also saw a drop in their sales there last quarter. The Skechers CFO, John Vandemar, told investors that China was a drag on international markets there. And so really what we're looking to see here is how much of an impact in the coming months, in the coming quarters, will we see from these U.S. brands like Tapestry, Ralph Lauren, but also thinking about fast food and also other American companies like, say, Apple and Tesla, how they'll perform in these coming quarters because of this tariff and these negotiations at 125% staying in place right now.
I mean, it's interesting, as you say, obviously this is probably most acute in China, but what we've been hearing about also is what's happening in Canada, perhaps because it's more transparent. We're hearing a lot of rhetoric. We've heard things about, that in Canadian grocery stores, for
They're
example.
saying grown in Canada, locally produced.
Well, just like here, when you go to the grocery store, it usually tells you where something is from, right? Produce especially, but other products as well. And in Canada it does, and people are there's a backlash against American products.
Yeah, absolutely. And when you're uncovering this story, of course, Lululemon is a Canadian company. And when you think about Lululemon as an American consumer, maybe the fact that it is Canadian doesn't come first to mind. But when I spoke to people, they were saying, Lululemon really also emphasizing that they are a Canadian company. Something to keep in mind there, just something I've been hearing as I spoke to people as well.
So maybe the perception of them in a place like China is different. I guess we'll
wait and see.
Yes, Brooke, thank you very much. Well, U.S. markets getting clobbered once again after Wednesday's historic rally. With uncertainty remaining the word on the street, we're looking at how investors should navigate the road ahead. Janney's chief investment strategist, Mark Lucchini, joining us now to discuss. Mark, it's good to see you as always here. So after these couple of days where reality seems to have sort of sunk in here and the market's realizing that there is some level of tariffs that are here to stay for a while, what are you telling clients at this moment?
Well, one, we were telling clients from the beginning of the year that this was going to be a period in which we were going to see far more volatility than we've seen in the last couple of years. So strap in and be prepared to look out over the horizon and stay consistent with your long-term financial plans and investment goals, all within the confines of a risk budget that is bespoke to your individual needs. And obviously, we're in the midst of a period that is very unsettling for investors as everybody's trying to make sense of the headlines that are seemingly oscillating the markets on a day in and day out basis, requiring daily doses of Dramamine. And, we're down obviously about 14% from the peak on February 19th. We still think we might see an opportunity here to even plumb lower levels before it's all said and done. Certainly the recent low here on Monday and Tuesday, but even worse if potentially we encounter a recession, which that risk seems to have been dialed down here a little bit in the last 24 hours. But nonetheless, coming into Liberation Day, we already seen the U.S. economy beginning to show some signs of slowing. And so any friction, even at the reduced levels of tariffs that you mentioned, could add even stronger headwind, if you will, to economic activity. So we'll have to watch the economic data going forward. But between now and then, investors should once again make sure that they're aligned in a way that allows them to live through these inevitable periods of enormous volatility and uncertainty, and the obviously associated with it gyrations that they're going to see in their statements when they open them up at month's end at the same time.
Mark, let's talk earnings season because it's here with those banks reporting tomorrow morning, Mark. One question that's been raised is the extent to which CEOs and CFOs, they're going to get on the conference calls, Mark, and just say, listen, I'm pulling my guidance because I can't give investors in the street a forecast with any degree of confidence. I'm curious, one, Mark, whether you're expecting that. You think we're going to hear a lot of that? And two, if we do see that, Mark, how you think the market would respond and react?
Well, I think that's going to be a problem for the market. I mean, we already saw, for instance, Delta pull its guidance over the balance of the year. And so if, in fact, we're going to see more of that, and I suspect that we will, how can any CEO or any CFO right now project forward, given all the oscillations in policy that we've seen on tariffs, let alone the potential benefits that may accrue ultimately from deregulation and obviously the tax cut package that's working its way through Congress as we speak. So there's a lot of machinations that are going to influence projections about earnings in subsequent quarters that I think is going to keep the corporate suite from being too convicted in what the view going forward is likely to look like. And right now, the S&P 500 estimates are still for about 7 or 8% earnings growth for 2025 over last year. And so hinging on that is going to be any kind of crystallization expectation around the prospects that that's likely to be achieved. Otherwise, the forward earnings estimates that right now the market is still somewhat richly valued, believe it or not, even with a 14% drawdown at about 18 times those still 12-month forward estimates, could continue to see further derating as a consequence if those earnings expectations aren't likely to be met, which isn't going to help the uncertainty that investors are dealing with right now.
Mark, where in the market do you think is more appropriately valued, that even is attractively valued at this point, that maybe you would steer investors into?
Well, first of all, I think it's important at this particular moment in time to think about staging money into the market. It's not an all or non-binary decision, but rather think about it in tranches. And I like to think that if we do see lower levels, there's going to be more opportunities to put cash to work or rebalance portfolio from bonds to stocks, if, again, appropriate for the individual investor's circumstances. But right now, I still see opportunities in some of the more certainly classic sectors, the defensives, that are holding up relatively better than some of the cyclical names, but also even in the bludgeon technology sector. Think of the Magnificent Seven, not necessarily uniformly, but there are high quality companies within the Magnificent Seven that have been derated to levels that look pretty attractive. The poster child, of course, being NVIDIA, that's gone from 36 or higher multiple on a forward earnings basis to something in the low 20s. That looks pretty compelling given still pretty bright prospects for their future. But even more so, we're finding very interesting opportunities in overseas markets, particularly in Europe, which isn't immune to seeing a further volatility and decline in their equity market. And once again, I'm not suggesting going and shifting capital unilaterally over European equities, but rather staging it in, because I think there is a secular change afoot that's taking place in European equity markets because of the dynamics between the US and Europe that's going to be persistent in allowing the valuation disparity that right now favors European equities to compress over time and allow for a better performance to come out of European equities than perhaps any time we've seen over the last decade plus relative to the US equity market.
Mark, always great to have you on the show. Thank you for your time today.
Thank you, Josh.
Time now for to watch Friday, April 11th. It's time again. Banks are kicking off another earnings season. We're going to be getting reporting from JP Morgan, Morgan Stanley, Wells Fargo, and Bank of New York Mellon. JP Morgan announcing results for the first quarter before the markets open. Analysts expecting higher trading revenue to lift the big bank in Q1, but economic uncertainty and weaker consumer confidence will also be a focus on that earnings call.
Speaking of the consumer, some soft data coming in the morning with consumer sentiment. Economists see that number falling to 53.8 in April. That would make it the fourth straight month of declines as consumers navigate President Trump's rapidly changing tariff policy.
And sticking with the economy, we're going to be getting more inflation data tomorrow with PPI. That's the Producer Price Index. Economists forecasting both total and core PPI to increase to 0.2 and 0.3% respectively on a month-over-month basis.
And finally, another round of Fed commentary coming in the morning from a few Fed presidents. It's coming after comments earlier today from Dallas Fed President Lori Logan. She said that the Fed must ensure tariffs do not spark lasting inflation.
That is a wrap on today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.